Banks enable the flow of money and credit within the economy. A bank's health reflects the overall economy's health. But a banking crisis has the potential to spread into the whole economy. All problems, be it a lending crisis, a recession, or bad assets, must be resolved from the bank level. So the question is, how to help these banks where there is a problem?
One possibility is just clean up the banks. These are having bad assets, do an audit, sell all those bad assets. The idea there is once the banks are clean, investments, capital will flow into the banks. The other view is if you just clean up the banks and leave them, you have showed to the world that these banks are having bad assets. They may end up being worse than what they were before. And if the capital does not flow, they will not be able to do even the kind of lending that they were doing before.
But how to evaluate the impact of a cleanup? The tricky bit is that cleanups only take place during times of crisis, which makes it difficult to determine whether the outcome is a result of the cleanup or due to the crisis itself.
So we found a unique setting in the Indian context where an asset quality review was done during a non-crisis period. Where in 2015-16, as you know, there was no big crisis going on in India. Economy was growing at 7%. And the RBI decided to conduct what is known as an asset quality review. Asset quality review is figuring out what's actually going on in the banks. What is the true bad assets banks have? You know, they were under this forbearance regime where they could restructure loans and not call them NPS. RBI sort of withdrew this regime and did an audit to figure out what was the true state of affairs of banks. And because this happened in a non-crisis setting, we as researchers got an excellent opportunity to actually identify the impact of cleanup. Right.
To test this natural setting, data was collected on bank lending. Loan-wise data of all loans lent by banks to firms were taken from the Ministry of Corporate Affairs website. Data on the quality of firms in terms of their financial information was taken from the CMI prowess. Then the two data sets were merged.
The question we wanted to ask was what happens to lending after this cleanup? Do banks get recapitalized automatically like one view predicted and then they start lending to good borrowers, or they end up being in a worse situation, undercapitalized, and not lend to good borrowers?
To understand the outcome of lending, the divergence declared by the RBI was used. This is the mismatch or difference identified between RBI's assessment of the bank's financial health and the bank's own self-assessment in terms of the accumulated bad assets.
Let's say a particular bank claimed 2% as their non-performing asset, which is bad asset. But RBI found that they were 10%. So the divergence in this case is 8%. So this is our treatment indicator. Higher this divergence, higher should be the impact of the cleanup. This is our identification assumption. Whether banks which had a higher divergence or higher treatment, what happens to their capital? Do they get immediately recapitalized? We test this explicitly whether these banks raise capital. Suppose some bank was claiming an NPA of 2%. RBI said no, it is 10%. That means they have to make provisions for this. Provision is a hit on their profit and loss account. It's a loss. Ultimately, that reduces their capital. Now we test whether they bring back their capital to original level by raising money. The answer is no, they don't. They remain undercapitalized. Neither government banks nor private banks get recapitalized. If you clean up banks and leave it there, you will leave them in a worse situation than before. And what we find is a one standard deviation increase in divergence leads to a 25% reduction in credit by banks which are more exposed.
Now that banks were undercapitalized, they did not have enough money to lend further. This would naturally increase the motive to gamble and take risks. To understand deeper, borrowers were studied based on their past accounting through a metric
called interest coverage ratio, to consider borrower as good or bad. Bad borrower is someone whose profits are not sufficient to repay even interest. Technically, they are insolvent, right? So what we find is these banks which are now undercapitalized after a cleanup, they increase lending to bad borrowers. This is like risk shifting.
This is called zombie lending, where banks keep lending and spending resources on risky, bad borrowers, which leads to more delinquent loans in the future. Further, this causes a series of issues.
Now that you give them more credit, you will have more such firms surviving. And because more such firms survive, the resources will go to such firms. Because they are inefficient firms, their investments are likely to be inefficient. More projects are likely to get stalled. More importantly, entry of new firms also will get impacted. Because in an industry, if most of the firms are zombie firms and if they are cornering all the resources, productive firms will find it hard to get resources.
Another impact is seen on NBFCs and shadow banks.
Because banks fund shadow banks, their source of funding will get cut and then your project is stuck. Firms are not able to substitute this. The total flow of credit to firms falls by 38%. Credit growth almost collapsed after AQR. By 2018, we had almost zero credit growth. NBFC credit growth became negative. Credit to small firms was -5 or -6%. Exposure to bad quality firms almost doubles and firm investments falls by around 20%. All these numbers are large. It's not some small 1-2% change here and there. These are not only statistically significant, these are economically meaningful.
The overall lack of investment and increased risk can have negative effects on the whole economy through the borrowers and can slow down economic growth.
What appears like a harmless cleanup, if done with noble intention, ended up making life difficult. Our message of the paper is not that cleanup is bad. The point is you should do a cleanup, but along with cleanup, recapitalization also should be there.
These are important takeaways not just for banking researchers who think about cleanups, but also for policymakers to make sure recapitalization isn't an afterthought.
In fact, Economic Survey cited this paper. It's already reached policymakers. Fortunately, this time, when COVID time, when they announced some policies which allowed banks not to recognize bad assets, they did not let bad assets accumulate. So this has had some reach to regulators.
These findings suggest that just reviewing the quality of loans and banks may not be enough to fix financial problems, even during normal economic times. It is important to also address the issue of undercapitalization.
It is a very important lesson for design of cleanups. This is not the last time you're going to have a banking crisis. And India is not the only place where you will have a banking crisis. Whenever a central bank gets into cleaning up banks, there should be automatic recapitalization. And second is the root cause, that if you let bad assets accumulate in banks, there are no easy solutions. Any measure that you announce as an emergency measure, make sure it's actually an emergency measure. If you let it prevail even after the problem is gone, that will create, like medicines have side effects, these things have side effects. And then you don't have good choices. So that's the bigger lesson.